Hi, everyone. Thanks for joining, taking time out of your schedule. This is a slide for regulars will know we use this all the time. I think Alex has really covered much of the 2025 performance. What I would say is it was it was really hard to find an asset class that was down last year. Bitcoin's there down, 4.4, not a huge amount, but it's down. What's also interesting is after many years, perhaps as long as a decade, international stocks did meaningfully better than the US stocks. And they continue to do so today, meaning year to date, few weeks, but they continue to notably outperform the US. So that trend continues. Nothing particularly notable on the Treasury. This is the 10-year yield. Didn't really move much. If I look at my screens today, it's at 4.25%, so not much there. And I think Alex, these are domestic sectors, and Alex covered this pretty thoroughly. No surprise, technology, communication services. This is where Google and Meta reside, communication services. And the more value end, consumer staples, real estate, still up, which is kind of, again, to my point, unusual, but up less than the leaders. My slides, the next four slides are going to touch on the economy. This is kind of the cadence I've done over the past. They're going to have a couple of slides on AI, as if I can cover this AI debate in 2 slides, but I'm going to give you some data points. And then we're going to go into the markets and specific asset class slides. So, I've shown this, I've kind of discussed the imbalance of the economy. K-shaped economy seems to be the term these days. Here's another good example of what's going on. And this is from the Financial Times. The top 10% of earners, income, I guess, which would also mean income from assets, consume almost 50% or contributes 50% to consumption. The bottom 80% contributes less. This, I think we can all agree, is an unhealthy dynamic, but it is what we have today. I think it makes consumption, don't forget, 70% of GDP is consumption, makes consumption very exposed to asset prices. Stock market being the obvious one. We all are aware of the rising social schism. You're seeing, because of this income gap or a smaller number controlling higher incomes, places like California proposing a wealth tax on assets, kind of unrealized gains, which I think is probably jarring to most people. With that background, it is not surprising that the sentiment, the consumer sentiment, this is what this soft data is really, is terrible, right? If you look at it, it's pushing kind of all-time lows, even as the economic activity remains pretty robust. I guess I'm just pointing an obvious trend, but this again ties in with the earlier slide. The economy is doing well, but most people are not feeling great about their own prospects. This is something to keep in mind. If you say, oh, I'm not in that 10%, and you are retired, and many of our clients are, it's a good probability that you are. This is actually an older slide. This is from 2023, and I think this trend would have even gone further higher. But given what's happening with demographics and the asset price increases, it's a pretty unique time in U.S. society where if you say 65 and older, let's call it retired community, is now the largest consuming group. And it certainly drives certain behavior. We shouldn't be surprised that healthcare is one of the highest inflationary baskets of services. And then, again, goes into my theme of, this is not quite unhealthy social schism. So I unfortunately don't think that this is going to change anytime soon. It's just an area we're unfamiliar with, but this is a trend that is likely to persist. The last slide is again, goes back to 70% of GDP is consumption. more than a third of the consumption basket is services. It's not buying TVs or goods and things like that. It's services. And we have been blessed with a pretty high immigration that would have kept, you increase the labor force, keeps wages down and keeps inflation down. And, we have seen a very sharp decline in net immigration. This is from the Brookings Institute, so it's not any biased opinion. And I asked the question, like, what does that do to inflationary pressure down the road? We have an aging population and need, the economy is doing well. We consume a lot of services. Who's going to provide those services? Because I don't think in a kind of 5-year view, we're going to have AI and robots, servicing us or providing services. So this is going to be a theme of what I'll come back to, the inflationary risk. As Alex said, we've had lots of questions from clients and our network about AI. Hey, is this a bubble? What I will say is this is a collection of headlines that I got from the Wall Street Journal and Bloomberg. It is probably the top focus of the financial media and investors. And that's a good thing, because when there is a heightened scrutiny, it allows, or it leaves less room for things to get out of hand. And so that alone, I think, makes it less likely that we go into a bubble. Yes, there was similar debate. I was in the markets investing back in 99 and 2000. And that was probably an exception where we talked about it and it turned out to be a multi-year slowdown. What I would say is the focus now is on these very large companies, and all of whom is funding this growth through their internal cash flows. Yeah, they're taking a little bit of debt, but it's so minuscule. So unlike the 2000 environment, these are large companies. These are not small companies that were created in the last 5 years. So that in itself should give us a lot more stability in this whole environment. What there is no debate about is that the growth, the demand for AI computing, and this is over roughly 2-year period. These are growth rates, anywhere from 10x to 400x. This is not percent, right? So this is 10x means going from 1 unit of demand to 10, or going from 1 unit of demand to 400. It's undeniable that there is, I see my own usage of it. I think the big debate is, it's one thing to provide the services, the capacity, but are we getting, or are these companies getting a positive return? And not just a positive return, but a high return, because their prior business models are asset light, meaning they didn't have to spend money and have very high returns. So I think that's the huge debate. It is an area that is highly, attentive or focused on the financial media and investors. And I don't think it's going to be hard to decide if what's happening, what the future will come through. But we know they're trading at high valuations, to Alex's point, and there is this uncertainty about how the returns will pan out for their investments today. I don't think there's any debate that AI is real on a 5 to 10 year view, but do we get the returns from the companies making these hundreds of billions of dollars of investments? There's also the common sense view on US companies. And again, Alex pointed this out. I could have put this slide up 2 years ago and you'd have the same conclusion. Top 5 US tech firms value exceed the combined GDP of all of these companies. Just to be clear, it's this bar chart here. This is the top 10. Yeah, common sense says it looks overdone. That does not mean it's, that we should assume it's going to be like 2000, where things went down 50 to 80% over a 5 to 10 year period. It could mean kind of modest underperformance with some of the other areas of the US market going higher and maybe other markets outside the US. But again, the sniff test does kind of tell you, yeah, is this really what I want? Is this where I get value from? Another one of the ratios to look at on the same theme is something called the Buffett ratio. Pretty simple. The market cap of the US stock market, and we use the Wilshire 5000 index over US GDP. And honestly, yes, it's high, but in like 2020 or 2019, really, you could have said, oh wow, it's looking expensive because it's above the 2000 level, and you sell and go to cash. I mean, that we can all agree would have been a bad decision. So again, my two things. These are not timing decisions. They can stay elevated for years. And I would also point out that the US companies and the stock market as a whole is far more international than it was in 2000. So while we're using the US GDP, don't forget, NVIDIA is a good example. Over 50% of its revenues come from outside the US. So shouldn't we be taking the US, not just US GDP, but the denominator should go up, which in turn would make this line lower. So again, yes, it's a Buffett ratio. It's been flashing red for a while, but there are factors that probably augment or push back against this argument in a pure sense. So now I'm going to slide on to the market valuations, asset prices. This is a new picture. I usually put the line charts of valuation. This is a bell curve of earnings growth. This is historic 5-year earnings and the PE ratio, price to earnings ratio. What you see is both of them are at the right extreme, meaning they're in these very rarefied air. You don't get this kind of growth, nor do you get these kind of high PEs. And, to reiterate what Alex said, the market is pricing continued earnings growth, and the risk, I'm not saying something enlightening, is that the earnings growth doesn't show up. I would add, the current administration is not shy about telegraphing that they only care really about growth. They do not care about inflation. Hey, we're going to get rates down. We want to get growth higher. And, sure, it's tied in with November this year and, perhaps 2 years on. I think I have increasing confidence that for 2026, earnings will be fine. The question is what happens down the road? What's the negative repercussion of running, I use the term, running it hot. And that is likely to be inflationary. And bond markets, I would argue, are already worrying about that scenario. So this is a busy chart. But what I'm trying to tell you is even as central banks cut their rates, because they only control short-term rates, it's this black line. This is the US. You're seeing long-term 10-year rates continue to go higher. And it's most obvious in the UK, right? A notable cut in short-term rates. Hey, the markets don't care. They're like, we don't like the outlook. And the long-term, the yellow and the red lines are going up. You're seeing the same in France, to a lesser extent here. And of course, Japan's different, where both are going up. And this is a shockingly high increase for long-term rates. This is a chart on emerging markets, but you could put in all of international, it's the same. And, yes, international did really well. People have asked, oh, is it done now? Should we now go back to the US? And I would look at this chart as opportunity. So last year's outperformance is just that. So we had over a decade of underperformance by international. So you were well off by staying in the US. The idea is that, there is many years for this outperformance to continue. And it's not like we haven't seen it before. So I started working and investing right around here. And you saw a decade of significant outperformance in international markets where you did so much better in international stocks versus US stocks. And so, keep this idea open, because there is certainly room for this trend to continue to grow. I have touched on gold all through last year. And this chart just shows, if you look at the global central bank reserves, and this is primarily, almost entirely driven by prices going up. It's not like the central banks have bought more gold. The central banks now own more gold in reserves than they own US treasuries. My take is that, and I met a bunch of them in my career, these are very conservative people. And as their holding of gold in US dollar terms goes up, they are less likely to buy. And just like we talked about in the past and today, hey, the winners, Mag 7, the mega caps, you want to take some chips off the table and maybe put it into other areas. I am inclined to say that, gold's done incredibly well, especially if you haven't rebalanced. These are the times to be thinking about rebalancing it, so you position size to be able to absorb volatility in the gold price. I will say, and I think in this new environment that gold remains an essential ballast. But if you started off at a 2% position and now it's 5, 6, 7, you might want to evaluate that position size. One last thing, I've also talked about Bitcoin for most of my presentations. Simple one. This is a survey done by Bitwise and Verify. All I'm trying to show is that, amongst wealth managers like ourselves, 32% allocate client portfolios to crypto and Bitcoin. It was only 6% in 2019. Nice steady growth. I would even make the case it is no longer a fringe allocation or an asset. At 32% expecting growth. What's also interesting is when you survey the wealth managers themselves, a much higher percentage of them own Bitcoin and crypto than is in client portfolios. And some of this is that Merrill Lynch just at the beginning of this year was allowed to allocate client portfolios to crypto assets. So, in conclusion, our concluding slide, it hasn't really changed much from 3 months ago, and that kind of makes sense. We don't change things quarter to quarter or even half year to half year. The key messages will be there's both risks and opportunity in what is happening in the economy. We are clearly trying to overweight growth. This is administratively and policy-wise, and that is going to be good for earnings, and that's an issue for next year in the short term. But the question mark is what happens longer term in terms of inflation, and that's probably more of a concern. One of the valves, exit valves, may not be in stocks, but it could be in the currency. And you're seeing the US dollar weaken just this year, notably kind of below the kind of a support level. In stock ideas, I say maintain international. For my own kind of younger, more risk-seeking clients, I've increased international allocation, but I would continue. It depends of your risk allocation, but that's something I would continue to own. We've said before, reduce the US mega cap exposure. What would you do with it? I say add to value, staples, healthcare, industrials. I mean, not all of these are value. Like industrials there's some value, there's some growth. Look at other areas. And honestly, if AI is successful, it's going to dissipate into the wider economy, driving better margins and better profitability for the 490 companies of the S&P 500. More than they do for the 10 companies that are investing in this theme. In fixed income, in bonds, same story as before, stay balanced, tips, short-term and intermediate. We don't like the long-term because of what we talked about earlier, inflationary pressure, rising fiscal deficits. So we're avoiding that area. credit spreads are at historic lows. That makes junk bonds and private credit, for example, less attractive. To sum up, rising deficits, worsening geopolitics, economic stimulus. What does that mean? To me, Bitcoin and gold remain a strategic hedge, taking a long-term view. This does not mean, as you saw, Bitcoin was down last year. It's just a solution for the next 6 months or something. You got to take a long-term view. And as Alex was saying, things are calm. Maintain the capacity to add to pullbacks, and that means making sure your portfolio fits with your risk goals and your retirement plan.